Welcome back to the channel. Lot to unpack, lot to talk about this week. Now, with the Bank of Canada cutting an additional 0.25% on Wednesday, March 12th, that marks the 7th consecutive cut by the Bank of Canada, reducing the overnight lending rate of the Bank of Canada's policy rate to 2.75%. Now, with this most recent press conference and rate announcement, a lot of the conversation revolves around the uncertainty and fears amongst Canadians when it comes to the US tariffs and how this uncertainty could be playing out into the Canadian economy, and more important, how it could impact inflation here in Canada, potentially triggering the Bank of Canada to maybe have to increase or raise its policy rate in the future. I want to take an opportunity this week, discuss the most recent press conference, share our thoughts and opinions on what the governor and deputy governor had to say, unpack all of that this week. Welcome back to the channel. If you have not yet subscribed, we invite you to hit that subscribe button, hit that notification bell so you can stay up to date with everything that's happening in the mortgage and real estate marketplace. And with all this uncertainty, this back and forth with these tariffs, stay up to date with what's happening here and how these tariffs, these changes could be impacting the Canadian economy. And more importantly, how is it going to impact Canadians when it comes to their mortgage renewal and those interest rates? That is the bigger question. Now, a lot of Canadians paying close attention to the Bank of Canada. Ultimately, over the course of the last few years, a lot more attention is focused on the Bank of Canada and those policy rate decisions as a barometer for what's happening with mortgages and interest rates, especially now with those 1.2 million Canadians that are going to be approaching mortgage renewal in 2025 and into 2026. A lot of uncertainty plays into where Canadians could be headed when it comes to their financial well-being, their budgeting, especially when it comes to their mortgage, their biggest investment, and obviously their biggest expense for a lot of Canadians. Now, with the Bank of Canada's most recent press conference, I think it's really important to unpack some of these fundamentals. Some of the biggest takeaways from this conversation is obviously, of course, the Bank of Canada cut 0.25%. That means that for Canadians with variable rate mortgages or anything that's based on a variable product, whether that be a mortgage or a line of credit or loan, it's important to understand that this means that most of the major banks, the prime lending rate is what is affecting Canadians when it comes to their mortgages. That prime rate has now moved from 5.20% to 4.95%. And just to put it very simply, the 0.25% translates to around $15 per every $100,000 of mortgage. So if you wanted to run some quick math or you wanted to get a better understanding of how potential rate cuts could impact your mortgage, or you want to find out more about refinancing or other tools, feel free to download our app in the description box below. But now what I'm going to do is talk a little bit about obviously the information that was provided by the Bank of Canada. And right now, for most Canadians, we are aware that obviously Donald Trump and his tariffs are back and forth, on and off, and obviously changing so many different times per day, per hour, per minute. And, you know, something that was supposed to happen in February now might be getting delayed until April, where those reciprocal tariffs could be coming into effect. But ultimately, at any given time, we can see how fluid the situation is, where things could happen at any given time between filming and when this video launches. There could be additional news when it comes to these tariffs. So it's super important to understand that the Bank of Canada fully understands this and has even pointed to that.
In recent months, the pervasive uncertainty created by continuously changing U.S. tariff threats have shaken business and consumer confidence. This is restraining household spending intentions and businesses' plans to hire and invest. Against this backdrop, and with inflation near the 2% target, the Governing Council decided to reduce the policy rate a further 25 basis points. Looking ahead, the trade conflict with the United States can be expected to weigh on economic activity while also increasing prices and inflation. Our surveys suggest that threats to new tariffs and uncertainty about the Canada-US trade relationship are already having a big impact on business and consumer intentions.
The Governing Council obviously made the decision to cut 0.25% and not more, based on the fact that, hey, this uncertainty is moving and impacting the Canadian economy. Even though the tariffs haven't kicked in into full effect with that full 25% on all goods entering the United States, or the 10% on energy and oil, and that 25% on steel and aluminum. Obviously, still up in the air. A lot of changes happening there, but just the sheer conversation is actually having an impact on Canadian businesses and Canadian consumers like you and I, right? In the sense that if businesses start to see and feel these pressures that could be coming in the near future, well, a few things could happen, right? We've talked about it on previous episode, but I really think it's important because now the Bank of Canada governor is literally pointing to the exact same thing. He's saying that businesses right now are going to pull back on spending, right? They're not going to hire, they're not going to invest, they're maybe not going to grow their businesses, and definitely going to pull back on hiring, because if Canadian consumers, and based on the surveys, are going to reduce their spending patterns or basically pull back on that discretionary spending, well, it's going to have bigger, broader impacts on the Canadian economy. And what they're also pointing to is that even though we had a very robust Q4 of 2024, the last quarter ending off the year of last year,
economic data since our January monetary policy report suggests the Canadian economy ended 2024 on a stronger footing than we expected. This growth path is considerably stronger than we were expecting based on the information we had in January. The temporary GST/HST holiday has lowered some consumer prices, but January inflation came in a little firmer than expected at 1.9%. Inflation is forecast to increase to about 2.5% in March with the end of the tax break. At the same time, merchandise trade data suggests businesses on both sides of the border have stocked up on imports in advance of tariffs. As a result, Canadian exports and imports are both expected to be stronger than expected in the first quarter. But the impact on exports looks to be bigger, which should provide some offset to weaker domestic demand in the quarter. Of course, this pull forward in exports likely means weakness ahead.
They're expecting that 2025 first quarter may see a little bit more of a boost in GDP. A lot of it to do for a few different reasons with different components. One of them was the fact that a lot of businesses were front loading their import-export trade, especially those that have very close ties or depend on trade. While they're going to get as much of those transportation, those import-exports in and out of each other's country as quickly as possible before the tariff come in. So just to put it very simply. And also we have to understand that the HST GST holiday is now no longer in existence. So that could potentially have a further impact on inflation. And that is something that the Bank of Canada governor has pointed to, where they're expecting or anticipating that inflation for March may tick up to 2.5%. Now you might be wondering, Anthony, why are we talking about this? Is the Bank of Canada not going to cut? Are they going to pause? What is the situation? Well, it's a very fluid situation. If we just take a second and step back in time, back into 2022, when the Bank of Canada was on an escapade to raise rates significantly very quickly to basically bring down inflation because it had gotten out of hand. And at that time, they anticipated that was transitory. And with all that, the Bank of Canada was dealing with inflation. This time around, it is significantly different because tariffs obviously positioned to change the inflationary story here in Canada because it's pretty much targeted. But even though it may be targeted to specific components or products that enter Canada or leave Canada, those costs go up and the demand may come down, right? So these are things that the Bank of Canada are paying very close attention to. So, but why is this super important? Well, inflation is the main focus, pretty much the underlying theme of what I gathered from this most recent press conference, because ultimately the Bank of Canada has a framework. They have a mandate. That mandate, if you may recall, is to keep inflation steady and controlled at 2%. Price stability is the major focus for the central bank here.
Monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. The focus of the Governing Council will be on assessing the timing and strength of both the downward pressure on inflation from a weaker economy and the upward pressure from higher costs. As always, the bank will be guided by our monetary policy framework and our commitment to maintain price stability over time.
Unlike the U.S., where they have a dual mandate, arguably the U.S. has obviously the inflationary front that they want to maintain, but also maximum employment. And here in Canada, it's obviously more geared towards inflation and making sure that price stability remains at that 2% target. And what happens if it exceeds 2.5 to 3%? At what point will the Bank of Canada intervene or step in to potentially look at increasing those policy rates? Now, the real question is, will the Bank of Canada do that when we're facing a trade war, a tariff scare, potential tariffs that's going to raise the cost of all these goods, not only with the exchange, but obviously the cost, the tax to bring in all these items at an additional cost. That cost doesn't get absorbed by the government. It also doesn't get absorbed by the businesses that are manufacturing, for example, those products. The cost gets passed on to you and I, the end user, the consumer. And obviously, we saw in the past how these were major problems for the Bank of Canada and will continue to be a central focus of the Bank of Canada. So, if we keep that in mind, the real question is, will the Bank of Canada be forced to move the needle? And when asked about the potential to increase rates, the governor of the Bank of Canada pretty much said that they're not providing any forward guidance on the matter, which is obviously one of those things where the Bank of Canada is not going to give up their hand, right? They're not going to showcase everything that they're planning to do, because ultimately, if they were to say that in this particular scenario, it would definitely put a lot of fear into the economy, into consumers and their sentiment. Case in point would be if the Bank of Canada told you that they're going to be raising rates if inflation ticks up, well, that might trigger a lot of Canadians to also front load the market, where means they'll go and buy or spend quickly, more rapidly now than later. And remember, the Bank of Canada was very concentrated in their efforts, focusing in on the consumer sentiment. Now, the next time the Bank of Canada will be meeting, it will be April 16th. And at that point, we'll also get a monetary report. As we look at the Bank of Canada, we look at Canadians, these 1.2 million that are approaching mortgage renewal. I mean, a lot of them are dependent on what happens